Welcome to QAV, TK, episode
Thanks, Cam.
808. 808. It was a drum machine back in the 80s. All right, let's get into market news. Tony, where do you want to start?
Well, I think my commentary overall is I think this is a sign of the top of the market. And the market reached a high and it's off, I don't know, it's 5 to 7%. STW's down at least a couple of percent, maybe 3 or 4% this month. So my kind of headline summary is that it's shoot first, ask questions later. If there's some kind of miss in the results, even if there's a good reason for it, the share price drops double digits straight away. But shares I've got that I own who had great results, the share price, if it's lucky, will go up 1 or 2%, maybe 3%, and sometimes it goes down 1 or 2% because the analysts were expecting a beat. So it's a very unforgiving market, and it's not unsurprising given not necessarily the QAV stocks, but in market in general has lots of is overvalued, as we've talked about in the past. It's at the high end of its pendulum as it swings from, a PE of, a current PE of around 14, trailing PE of around 16, up into the 20s, and it'll come back down again, swing too far the other way eventually. But it's there's been a lot of problems and a lot of misreads too. I think we'll talk about one a bit later. Parenti, which it's a stock I owned. I thought the results were acceptable. Stock went down 15, 20%, and it's back up as the market digested what happened. But we'll talk about that in some detail later. But non-QAV stocks, I'm kind of glad I'm not in some of these, highly priced stocks. The WiseTech Global comes to mind. I mean, I know it's not down because of its necessarily being, bad results, although I think the results weren't great. But anyway, it's down a lot. And I think it's 29% having problems with the founder. 4 directors have quit. So there's a lot going on there. Mineral Resources, we spoke about once before, down 23% this month alone, down 70% from its highs as the founder there has issues. So there's a really unforgiving approach to the stock market at the moment, I think. And we're seeing it play out in our stocks. I guess, some of these stocks have been hit hard, super cheap. Again, I don't think it's necessarily warranted, but anyway, it had a miss and it was hammered. There's still cash-producing machines, and generally what you find is their falls aren't as big as the high PE stocks when they crash, like the ones I just spoke about. So anyway, that's my overall summary. I think people are becoming less forgiving. They're looking for signs of trouble, and they're thinking the market is overpriced, and maybe even just some profit taking going on because of that in the stock market as a whole.
And the Dow Jones is down as well.
Mm-hmm.
I don't know what the US market's worried about. I mean, everything's going so well over there right now. It's like smooth sailing. Can't understand why they would be nervous.
And a highly predictable economy and environment over there.
Highly predictable. Yeah. Like nothing to be nervous about.
Safe pair of hands.
Well, safe pair of hands when they're not waving to the audience. It's like that's the Musk salute, as I now call it.
I was going to talk about this in after hours, but since you brought it up, that's supposed to be a Roman salute.
It was originally a Roman salute. That's where the Nazis got it from, yeah.
He posted that he's calling himself the modern day Sulla. So,
Sulla, really?
Yeah.
He's going to pull a Sulla.
Yeah. Get shit done.
Well, you know what Sulla did?
I have listened to your podcast. Yep.
Yeah, for people who haven't, Sulla cut off the heads of his enemies. So in Rome, not the non-Roman enemies. Yeah. Blood in the streets during Sulla's. But as I always have to remind people, Sulla was dictator, and then he gave up the dictatorship, and went and lived with went into retirement with his wife and his male lover. Maybe that's what Musk is hinting at. Maybe he's going to come out that he's got a male lover. And then, of course,
certainly given the female side a go. Was he got 27 kids or something?
Yeah. Then when Caesar became dictator, he said, Sulla, Sulla was an amateur. He didn't know what he was doing.
Got out the blueprint and said, I can build a bigger one.
Yeah. Anyway, yes. So what else have you got? What other stories?
Well, I want to go through a few results. I'm going to start with the ones which were beats, and some of these aren't on the buy list now, but have been on the buy list. So I'll talk about them because people are probably holding them. First one is Judo. The Judo CEO proclaims a safe landing. This is from the AFR, and it happened after the interest rate cut last week. Judo Bank says the cut in the cash rate will help the business bank compete with major lenders that may protect margins by holding back some reduction for small business borrowers. In contrast to Bendigo and Adelaide Bank, which reported a squeeze in its interest margins on Monday last week and saw its shares crunched, Judo lifted its margin guidance in half-year results that beat expectations. The stock responded positively, with shares up 11% during the morning session to $2.14. Goes on to say that their margins are good. So this is Judo's a business lender bank, does hold a banking license, so it doesn't play in the mortgage market space. Their margins were in the stated range of 2.9% to 3%. And the article points out that's much higher than the margin at Bendigo's bank, which is 1.88%, and Westpac, which reported a contraction of its core interest margin to 1.81% on Monday. The pricing of small business loans is more bespoke, and Judo can lend to its customers at a wider spread than banks can for mortgages. The CEO, a guy called Bayliss, said, I think the safe landing has happened. We have seen a transition from a consumer-led economy based on household leverage to a business-led economy now. Businesses are in investment mode and the economy in growth phase. That's a big call, I thought, from him. But I guess he's seeing it. Judo goes on to say they reported $2.3 billion in new loans originated over the half, a record level, driven by growth in agribusiness, maintaining a growth rate above the average of the system as it expands into the regions. Bayliss goes on to say that he thinks the rate cut will be helpful. He explained this was due to major banks holding significant funding in transaction accounts, which pay very little interest. This means they cannot be further reduced as the cash rate falls, creating pressure on major banks to recoup a margin squeeze. Judo, which runs a traditional relationship banking model, has 159 bankers and will hire a further 20 in the next 6 months. Each runs an average of 28 customers, compared with the industry average of more than 100. The bank says this helps monitor credit quality, which was stable over the half, with 2.3% of the book 90 days past due or impaired. So, good result. Old-fashioned business bank, relying on customer relationships, and hit a few goals this half.
You did a pull book on them last year, I think.
Yeah, I did. Yeah, so they were on the buy list at that time.
Yeah, I bought them towards the end of September last year. Up sort of 20% since then. $2.04 though. Not you said $2.14 before. I've got them at $2.04.
Yeah, well, they must have come back. That was the price on the morning of the announcements, their results.
Right. Yeah, but they're doing quite nice in one of our portfolios.
Good. So the next one I want to talk about is QBE, and I hold QBE in my own portfolio. And this, again, was from early last week, February 21st. And part of the article was a response to Peter Dutton's call to break up some insurance companies if they didn't lower their prices. And so this is a quote from the CEO of QBE, a guy called Horton. And it goes, after QBE reported a stronger annual profit on Friday, this is the Friday previous, Horton said reducing costs for policyholders means lowering risk. He did say that scale and diversification was important for insurers. QBE only receives 3% of its total premiums from the consumer market in Australia, where it has not made money for the last 3 years. Even though prices have gone up, it does not mean it delivers a return on capital. Australian consumer insurance has been loss-making in a number of years, but we can afford it in total because of the rest of the business, he said. QBE's global diversification and a 3-year project to improve underwriting standards and exit more risky businesses helped drive return on equity to its highest level in a decade. QBE earns more from commercial, specialty reinsurance, and lenders' mortgage insurances than it does from consumer lines. It has extensive operations in the US, where it avoided the worst of the US hurricane season last year. It also said exposure from the LA wildfires in January was around $200 million. Its statutory net profit of US $1.78 billion for the full year was up 31%. It lifted its full-year dividend to 87 cents per share, up from 62 in 2023, representing half of its net profit. Gross written premiums were up 3% to 224 US billion, and it expects 2025 premium growth in the mid-single digits. Its shares were up 5.2% on the day to 21.12. So, well-run insurance business, 97% of its profit from overseas or income from overseas. And I would expect companies like QBE will do well because they're getting a big currency uplift, given the Australian dollars towards its lowest levels for quite a while.
Didn't really explain in that why they're not making money out of consumer insurance, though, in Australia.
Didn't.
Why would that be? So they said they haven't for a number of years.
Yeah.
It's been loss-making for a number of years.
Yeah. I'd speculate. I would think competitive market, because there's lots of insurers in Australia, and a rising number of events, floods, fires, whatever else in the last 3 years, which may not have been, they may not have provided enough for it, but they certainly can't raise their premiums enough to cover it, as there is a competitive environment. And there's also the political pressure calling for lowering of prices by insurers in general.
Political pressure from the opposition?
Ooh, yes. Still a threat.
The opposition that's probably been denying climate change for the last 25 years, and now it's costing insurance companies money, and they're telling them to drop their premiums because it's fake news. You know, climate change doesn't exist, so the insurance companies don't need to worry about it.
Yeah, and nuclear will solve it too.
Yes. I'm actually pro-nuclear, but the time to be pro-nuclear was 40 years ago. It's a bit late to be pro-nuclear now. All right. Well, I don't hold QBE. I just checked. How have they done for you?
Yeah, they're good. They were doing better. They have come off a little bit recently, but yeah, I'm guessing they're up sort of 25% since I bought them, something like that.
Good.
Yeah.
FMG.
Yes.
They're old friends.
Disappointments, because it came onto the buy list probably a day or two before its results came out, and the results came out and the share price was hammered and it became a sell again. So,
and you said, yeah, I think it's time to take the red flag off.
I did.
Paid the price.
I did. So maybe the red flag rule should be wait for the next results. Let the red flag flush its way through the system. Yeah.
Yeah.
Oh, you're right. I did say last week, let's use sentiment.
Sentiment. That's right. Yeah.
Yeah. So
how's the sentiment?
So cross that out. Let's wait for a set of numbers. But yeah, they were a terrible set of numbers. I guess
Isn't that interesting?
Longer term sentiment was accurate.
Yeah. Like I'm looking at their 1 year chart. Has not been good. Gone from $28 down to 18 today over 12 months. You know, we've talked a lot about the sort of political corporate goings on at FMG over the last year. Lots of directors leaving, senior management leaving.
Yep.
And then the results come out and they're terrible.
Yeah, and not just the exits of the management, I think, was the most telling thing. But I think Fortescue's it's got to clean up its act with its future industries division. And they've come out and said that they're going to reduce their capital expenditure by a fifth in that energy division, and is going to pause $1 billion of approved hydrogen projects, largely as a result of Donald Trump taking over the White House and its attitude towards clean energy. So Fortescue should really spin off its future industries division and make it a separate company. And then anybody who wants to play in that space, which is still unprofitable, can do that rather than having it cross-funded by the iron ore business. But anyway, the results weren't good. The net profit was less than half that reported a year ago and 12% lower than analysts were expecting. Revenue was down by 1/5, and the dividend of 50 cents was less than half the payment of the year before. So, terrible result all around, really.
But I think Mr. Forrest wants to fund the future industries business with his existing business. Isn't that his whole plan? He wants to be shaping the future, and he's going to use the past to shape it. I mean,
correct. That's his plan.
Whether or not it's his business, give or take, depending on how the shareholders feel about that. But yeah. Well, look, I admire that. I admire his attempt to move into future energy space and using iron ore revenues to sort of finance that as a startup. Whether or not he can pull it off, I guess, remains to be seen. If he pulls it off, he'll be a superstar again.
Yeah, exactly. And I think he's always been entrepreneurial. So if he thinks this is the opportunity for the future, then I think it's you've got to look at backing him anyway. But startups are very volatile and they don't make money for a long time. So it could be another business as big as Fortescue eventually. I think the other positive thing, which I think he's been trying to do, is to invest in hydrogen so that they can somehow mitigate the climate change effects of being an iron ore miner and supplying steel mills. If steel mills can start using hydrogen and produce less emissions or even clean emissions, then that's a real win. So I applaud him for that, but I personally would prefer to see it done in a separate vehicle. And if he needs to take loans from the iron ore group, or if he needs to use his own dividends to fund it, then go for it. And people can decide whether they want to invest in that or not.
All right. What about our friends at Supercheap?
Yeah. So the results came out. The Supercheap Auto, or Super Retail Group, is the company. But one of the biggest sections of it is Supercheap Auto, and that business underperformed. So they reported that they were battling a downturn in the automotive category, forcing it into deep discounts and punishing the profits of its parents, ASX-listed Super Retail Group. While group sales rose 4% to $2.1 billion over the first half, and same-store sales were up 1.8%, net profit was 9% lower. And below market forecasts. The stock tumbled nearly 14% on the day. They also claimed that earnings fell at their hiking retailer Macpac, where sales grew just 1.7%. In October, the company warned that the 2025 financial year was starting with softer sales and more promotional activity. So that came true. But at Rebel, the sportswear stablemate, sales grew 4.4% to $706 million in the half, culminating in record Christmas trade. Footwear and licensed NRL apparel delivered improved turnover, closely matched by fitness technology. But earnings at Rebel were eroded by higher rates of theft and the costs of establishing its loyalty program. So did you buy any NRL merchandise at Rebel for Christmas, Cam?
Surprisingly, Tony, no, I did not. I did steal a lot from Rebel though, during Christmas. Didn't buy it. I just stole it. I mean, apparently that's the way to do it. Yeah, Rebel. Interesting that sales were up for footwear and fitness tech. I wonder what's driving that.
Yeah, I'd be speculating. I suspect that Supercheap is down as people are taking longer between services on their vehicles as a cost of living measure. But if your sand shoes run out of wear, you got to go and buy them. So maybe sneakers and gym clothes are more of an essential purchase than servicing your car.
We should have Chem and Mab on. He's the footwear expert, isn't he?
Yeah, he is.
Hmm.
Well, another footwear company which did poorly was Accent One, which has also been on the buy list. The ASX listed retailer behind shoe chains Hype DC and Platypus and brand Hoka, I guess that's how you pronounce it, has posted an 11% gain in the first half net profit to 47 million, but slashed the interim dividend to preserve cash in a tough trading environment. Group sales climbed 4.2% to 845 million in the 6-month period to December 29, helped by same-store sales growth of 2.9%. Earnings before interest and tax rose 11.5% to 80 million. An interim dividend of 5.5 cents per share, fully franked, will be paid on March 20, but it's lower than a year ago at 8.5 cents, and it was also below market expectations at 6.4 cents. Accent opened 42 new stores, taking the total sites to 903 stores, which beat expectations. So shares went down, even though really good profit result, good expansion with 42 new stores being opened, but shares down on the basis of a dividend cut, which is always something a business is loath to do, and an indicator that they're quite conservative in their forecast going forward.
I don't hold Accent in any of my portfolios, but I should mention I do hold a super retail group in my own super portfolio, plus some of the light portfolios. And it hasn't been a great performer. I mean, in one of the light portfolios I've held it since August 22, and it's up 36%. But in some of the others, including the dummy portfolio and my super, I bought it around end of October, early November 2023. And it's sort of up somewhere between 5 and 10%, depending on which date I bought it at. Must have been having a bit of a price spurt at the time. But yeah, it hasn't had a good sort of 18 months since then.
No, well, yeah, I'm in the same boat. I should have said when I started talking about it, I own it as well. And it's, I forget now how much it's up for me over time, 10%-ish sort of number. But it has been coming down of late. The other comment I wanted to make about a lot of these stocks is why are they surprising the market? If the market was out there saying the dividend they thought was going to be one number and it comes in less than that, the company by law is meant to be making announcements as soon as they know that it's likely to be cut and the expectation won't be met. So what's the ASX and ASIC doing about all this? I mean, any of these companies we're talking about who've had misses should be grilled by both those regulators on their corporate disclosure. They're either ASIC and ASX are either asleep or they're incompetent, frankly, when it comes to things like this.
We've talked about this over and over again. We get surprised all the time.
Yeah.
And as far as I'm aware, nothing happens. There's never any please explain that I see come through in the announcements. It's just nothing to see. Move right along.
Yeah, which is wrong. Now, I don't know what the situation was at Super Retail Group, for example. I'm not singling them out. They may well have had a board meeting right before they announced their results and decided on the dividend cut at that stage. And so that was the first chance to announce it to the market. But they didn't just pull that number out of thin air. They would have been tossing it around internally for quite a while before that.
But it's not even just about the dividend, though. It's right. With all of them coming out and saying their overall results were not what the market was expecting, or not what they predicted in their forecasting 6 months ago or a year ago, it should have come out during confession season, shouldn't it?
Yeah, absolutely.
Well, it's obviously not, because the market's tanking them by 10, 15, 20% when the news comes out. So what's going on? Why aren't they getting hauled over the coals for not giving the market more warning?
Yes, well, to be fair, in Super Cheap's defense, they did come out with a confession. I'm just trying to look it up now as part of that article. In October, so going back to October, warned the 2025 financial year was starting with softer sales and more promotional activity. So that was a long time before the results came out, almost 6 months, and they haven't updated, as far as I know, with further announcements since then, which they would know about.
If only we had like a Australian Shareholders Association or something like that could take up these issues with ASIC on behalf of shareholders across the country.
Yeah, we should get Matt back on the show then. Holding to account.
Yeah. What are you doing? Haul him over the coals.
Yeah.
If they're not going to haul them over the coals. What about Challenger?
Yes, Challenger, another one that's been on the buy list for a while. They were a hit in a couple of ways. So they're a retirement product provider and fund manager. They have been under a cloud, according to this article, with first half profit and life sales coming in below expectations. Again, no warning of that. Just going to announce it with the results. Shares fell 9% on results day, culminating in a 20% decline over the past year. The $3.8 billion market cap company last closed at $5.47, flirting with lows last seen in June 2021. Institutional investors have also avoided the stock like the plague after major shareholder Wall Street asset manager Apollo Management reduced its stake in the annuities and fund management business to 9.9% from 20.12% in September. Naturally, investors are concerned about another possible liquidity event, but bottom-up analysts are scratching their heads, arguing the business is performing well and trading on a forward PE of just 9 times. And this is the dilemma for me with a lot of these companies, Cam. Okay, the results, some of these results have been misses. Well, a lot of them have been misses. But the companies are still throwing off lots of cash. And, you know, how cheaper do they have to get before people decide that, okay, its future may not be, its future may be a bit rockier, but, you know, they're still cash generating machines. They're still operating. They've been operating for a long time. They still do good jobs. I wouldn't be surprised if some of these companies have their share prices turn around as analysts come to grips with the fundamentals of what they've been reporting.
Yeah. Well, you know, we know the market doesn't invest like we invest. Not everyone in the market does, looking at the fundamentals. CGFs wasn't on our buy list, though, this week. So right. I don't know where they fell off.
Imagine the results. We've got the new results in, maybe they haven't measured up, perhaps.
Right.